Hey guys, welcome back. So right now I have a dividend growth portfolio that has about 37 different stocks and ETFs, and I've been pretty appreciative of it so far. But on a recent video, someone left me a comment, and shout out to them, by the way, and it got me really thinking. They basically said that with a $30 per week budget, I'd be better off investing in just 2 or 3 different ETFs instead of so many individual stocks. And honestly, that's a fair point. So in this video, I want to explore that idea and share with you guys 2 different ETF portfolios, each only having 2 different positions that can be very beneficial for low budget investors like myself. We'll break down what's in each portfolio, how they historically perform if you invest $30 per week, and how they compare to each other when it comes to dividend and share price growth income potential. And of course, shout out to ChatGPT for helping me get some of these graphs out, so let's get to it. Okay, so the first portfolio we have is the Core Dividend Growth ETF. And the first ETF in this portfolio is SCHD, which is the Schwab US Dividend ETF. This ETF tracks US dividend companies that have a history of increasing their dividend payouts to their shareholders for at least 10 years, and they currently have about 103 different positions. Now, over the past 10 years, SCHD has grown its share price by 96%, so 9.6% per year. That's definitely not bad at all. But the dividend growth is just as good, if not even better. They have a 3.95% dividend yield, so they pay about $1.04 per year, and their dividend payout has consistently increased for 13 years. As a matter of fact, their 3, 5, and 10-year dividend CAGR is about 11%. By the way, guys, I mentioned this a few times before, but the dividend CAGR, or compound annual growth rate, is basically taking a period of time, whether it's maybe 5 years, for example, it's giving you a rough average of the percentage increase in between each year to get from year 1 to year 5. So with that being said, 11% annual increase to get from point A to point B is pretty solid. You want something at least above the rate of inflation. 11% is dramatically above that. ETF number 2 in this portfolio is VIG, which is your Vanguard Dividend Appreciation ETF. Now, this ETF tracks companies that have paid a dividend for at least 10 years, and currently they have about 341 holdings. Now, when it comes to its share price, it's a lot higher than SCHD. Over the past 10 years, their share price has grown 139%, so 13.9% per year. When it comes to their dividend growth, they have a slightly lower dividend yield of 1.81%. But they do have also 11 years of consistent dividend growth and 18 years of consistently paying a dividend. When it comes to their dividend CAGR over the past 3 years, you're looking at 7.69%, 5 years 11%, and 10 years 7.54%. So not bad at all. So the Core Dividend Growth portfolio with these 2 ETFs is giving you an overall portfolio that tracks companies that not only have paid a dividend for consecutive years, for 10 years, but have consecutively increased it for the same period of time. You also have a portfolio that has a dividend yield of an average 2.88% with an average 10-year share price growth of 117.5% and an average 10-year dividend CAGR of 9.27%, which is amazing. What I really like about this portfolio is that it includes 2 ETFs that have very low expense ratios. Every ETF is managed by their respective company, whether it's Vanguard or Schwab or Fidelity, and based on how much they manage it, whether it's very active or very passive, determines how much you pay and what's called an expense ratio. So for both of these ETFs, you're looking at 0.05 and 0.06%, which is about $5 or $6 for every $10,000 you invest into it, which is something, but definitely not much at all. And that's simply because these are very passively monitored nonetheless, but very passively. You also get a pretty broad diversification of positions with both of these ETFs. SCHD's top sector is energy, whereas VIG is technology. And then of course, when it comes to dividends, you're getting a nice combination of high quality dividend growth positions, especially when you have one ETF that wants to make sure you're getting paid more and more each year, and another ETF that wants to make sure you're getting paid each year. So moving on, the next one is the income focused portfolio, and the first ETF within that portfolio is a pretty popular one. It's JEPI, which is the JP Morgan Equity Premium Income ETF. This ETF monitors large US cap positions and equity link notes, and it currently has about 129 positions within its portfolio. By the way, equity link notes is basically investing into something that will not only give you regular returns, but gives you opportunity for individual side returns. For example, that's like investing into something that's part bond, but also can give you some money in a call option. Now, JEPI is fairly new. It was incepted in 2020, but since then, it has a share price growth total of 11.17%. So it's fairly decent. But again, this is an income focused ETF, so the dividend yield is going to be super high. It's currently at 8.02%, which means every year you're getting paid $4.49 per year per share. And they currently have 4 years of consecutive dividend payments, which is great because they've only been existing for 4 years, but they have no years of consecutive dividend growth. So that can be a little bit concerning. On top of the fact that the 3-year CAGR is negative 1.87%. The other ETF is actually a personal favorite of mine, something that I have in my own portfolio, and that is QYLD, which is the Global X NASDAQ 100 covered call ETF. QYLD sells call options on an index that monitors the NASDAQ 100 so they can collect those premiums and you get those as dividends. And it currently has about 103 positions within its portfolio. Over the past 10 years, their share price has dropped 30%, but on the dividend side, it is a little bit better. Its dividend yield is currently 13.72%, so you're making about $2.25 per year per share. They have a 1-year dividend growth history, but 10 years of consistently paying a dividend. As somebody that has invested into them for about 5, almost 6 years, I have been consistently getting paid roughly the same amount every single month since then, so it is pretty cool. What does suck on the other hand is their dividend CAGR. Over the past 3, 5, and 10 years, their dividend CAGR is negative 6.49%, negative 0.7%, and negative 0.5% respectively, so not the greatest. When you combine these into what's ultimately their income focused portfolio, you're looking at an average dividend yield of 10.87% with a 5-year share price growth of negative 4.33% and a 3-year dividend CAGR of negative 4%. So that is not going to be great. You're looking at definitely limited share price growth. And on top of that, since both of these ETFs are getting into call options, you're looking at more active management, which is going to result in a higher expense ratio. The average expense ratio for these two is going to be 0.475%. So that's $47.50 for every $10,000 you invest into it every year, if my math is right. On the other hand, again, this is income focused. So dividends, passive income, you are going to get some higher dividend payouts, and the call options are definitely going to be very beneficial when it comes to that. Having a small ETF portfolio can be really beneficial for a few reasons, including and especially the fact that every dollar you have is automatically going into potentially hundreds of different positions without necessarily having to research all those positions, because you are completely aware of the mission statement that each ETF has, so you hope that the stocks that are within them follow suit. Of course, you have to pay an expense ratio that, at least with these examples, can range between $6 to $48 for every $10,000 that you spend, but that's just a little price you pay for the position to be automatically managed to make sure that those positions follow suit within the ETF. At the same time, and maybe this is just more of a kind of a mental thing for me, it is pretty cool to invest all your money directly into one position, so you can say that you have a lot of ownership in this position, and it just may be something that feels better, especially when you're investing into something that you're involved with in some way, whether you go visit them and get coffee every single day, or you've worked there, or anything like that. So with that being said, here are 2 additional small portfolios, each with just individual stocks. The first one is your Dividend Aristocrat portfolio. And the Dividend Aristocrat is any stock that has consistently paid and increased their dividends to shareholders for at least 25 years. This is made up of 3 different positions, and the first one is Johnson & Johnson. Over the past 10 years, Johnson & Johnson has grown its share price by 44.41%, so you're looking at about 4.4% per year, which is, it's okay. But its dividend payout and its dividend history is where Johnson & Johnson gets a lot of its popularity from, besides, Band-Aids and stuff like that. It has a 3.55% yield, which means it pays $5.20 per year per share, and it has consistently paid and increased its share price for 62 years, actually making it a dividend king, which is a stock that has done that for at least 50 years. On top of that, its 3, 5, and 10-year dividend CAGR is roughly 5%, so that's pretty solid. The next position is Pepsi, and Pepsi's 10-year share price growth is a little bit lower. It's about 33.44%, but again, dividend history is where it's at. Its yield is 4.43%, so it pays $5.42 per year, so a little bit more than Johnson & Johnson, and it has consistently paid and increased its dividend for 52 years, also making it a dividend king. On top of that, its 3, 5, and 10-year CAGR is roughly between 7 and 8%, so even better, definitely not bad at all. The third position is Realty Income. This is one of my favorite positions in my own portfolio. Its 10-year share price growth is actually the lowest of the 3. It's at 16.14%, but again, its dividend is where it shines. It has a yield of 5.91%, meaning it pays pays $3.22 per year. It also has 27 years of consistent dividend growth and a 3, 5, and 10-year CAGR between 3.6 and 3.9%. These are some pretty low numbers, especially when you're talking about the dividend CAGR, but keep in mind this is a monthly dividend paying position. On top of that, being a real estate investment trust or a realty income has to be able to maintain, I think, either a 70 or 90% payout from its free cash flow to its shareholders every single year. So being able to maintain that despite its low numbers is pretty cool. So with this portfolio, you're looking at stable, well-established companies with a very consistent dividend payout. But of course, in comparison to ETFs, you're looking at a lot less diversification because it's only 3 different positions, which could result in higher risk of that overall portfolio, especially if one of these 3 positions happens to have a couple of bad days. Now, our other small portfolio is our tech and income stocks, which consists of 3 different individual stocks. The first one is TXN, or Texas Instruments. It has a 10-year share price growth, a ridiculous one, of 239.89%. So you're looking at 24% average share price growth per year, which is insane. When it comes to its dividends, it has a dividend yield of 2.9%, or about $5.44 per year. And with its dividend growth, it has consistently paid and increased a dividend payout for 19 years. And its 3, 5, and 10-year CAGR is roughly 6, 9, and 15% respectively. So I think out of all the positions I've covered, this might equally be the best, but it has its own flaws. We'll get to those in a second. The next position is another one of my favorite personal positions. It's Main Street Capital. It has a 10-year share growth of 78.48%. It also has a dividend yield of 7.78%, so it pays about $3.06 per year. When it comes to its growth, it has 4 years of consistent dividend growth and 13 years of consecutive dividend payments. But keep in mind, they started paying a special dividend in December of 2021, and as you can see, it was a lot lower than the regular dividend. So that's where it only has 4 years, or why it only has 4 years of consecutive payments, but you're technically getting more every single year starting at that point in time. But anyway, it also has a 3, 5, and 10-year CAGR of roughly 5, 3.8%, and 3.8% yet again. And then the third position is actually realty income again, but we just went over that, so we'll skip that. Now, the pros of this is going to be a blend of growth and blend of passive income when it comes to dividends. Speaking of the income, when it comes to dividends, realty income and Main Street Capital are going to pay you every single month, which is really cool if you're hoping to live off that income, or you at least want to be able to pay your bills, which happens every single month. But the biggest con with this is your exposure to volatile sectors. Texas Instrument is in the tech sector, which is historically has been the most volatile sector, which can be great, but it can also be a bad thing. So when it comes to the 4 positions, I really want to compare them when it comes to dividend income and share price growth, and this is what I discovered. Your income focused ETFs are going to have your highest dividend yields, but your tech and income portfolio are going to have your highest share price growth and your highest 10-year dividend growth. But again, it's made up of the tech sector, which is very volatile, so risk of occasional down moments can definitely happen. And finally, I wanted to see, when it comes to investing $30 a week, based off its previous 10 and even 15-year history, which small portfolio is going to do the best with my money. I also added $20 every single week, especially for people that don't even invest as much as I do, even though I consider myself a low budget investor. But anyway, this is what I figured out. Out of all 4 small portfolios, your tech and income stocks are going to provide you the most returns in 10 to 15 years, whether you invest $30 a week or $20 every single week, followed by your core dividend ETFs, your income focused ETFs, and then finally your dividend aristocrats, despite the fact that that portfolio should provide you the most consistent dividend payouts. Having a minimal as far as the number of stocks when it comes to a portfolio is something that I do strive for to an extent. One of the goals I've had over the past year or so is to really minimize the portfolio that I have when it comes to the number of stocks. 37 is a lot, but at one point, I had about 48, almost 50 different positions, and it has its pros and cons. One of the biggest cons is actually being able to track and really understand what's going on with each different position. So that is something that I have, and it's a goal I'm continuing to track by making sure that every single position is accomplishing the goal that I'm trying to accomplish for an entire portfolio. And even if it is, maybe that money can still be better elsewhere, and resulting in maybe a minimization, if that's even a word, of my portfolio and how many positions I have in it. But my portfolio is doing pretty well so far. I actually made a video about how it behaved over the month of April when it comes to dividend payouts. I actually did a pretty good job. So whenever you guys get a chance, make sure you check out that video. I appreciate you guys watching this video. And until next time, as always, take care.